The automotive industry is undergoing a massive structural shift toward electrification and autonomy, and while most investors are focused on Tesla and the usual mega-cap names, a small-cap company called INDI Semiconductor, ticker INDI, is quietly embedding its chips into the brains of next-generation vehicles. But after recent volatility, the big question is this stock actually a buy or just hype? Let's start with the numbers, because INDI's growth story is real. Back in 2023, revenue surged an impressive 101% year over year to about $223 million, showing strong demand for its automotive chips. Then, in 2024 and 2025, growth paused slightly, with revenue around $216 million to $217 million as the broader auto and semiconductor market softened. But this isn't a broken story, it's a timing story, because analysts now expect a major reacceleration, with projections pointing toward more than $600 million in revenue by 2028 as advanced driver assistance systems, radar, and vision chips move into full-scale production. Now let's talk profitability, because this is where things get a bit uncomfortable. INDI is not profitable yet, reporting a GAAP net loss of about $12 million in Q4 2025. But losses are narrowing as the company scales, and most analysts believe break-even is within reach, likely sometime in late 2026 or 2027, which is typical for a company still investing heavily in future growth. But the real reason investors are paying attention is the company's $7.4 billion strategic backlog, and this is not just speculative demand. These are design wins already secured with automakers and Tier 1 suppliers across radar systems, vision processors, and even emerging areas like robotics, effectively giving INDI a multi-year pipeline of future revenue. However, this is where you need to separate hype from reality, because that $7.4 billion doesn't show up overnight. In fact, very little of it converts in the near term, and the entire investment thesis comes down to timing and execution. So in 2026, you're likely looking at roughly $280 million to $350 million in revenue conversion, which is only about 4 to 5% of the backlog, making it more of a proof year than a scale year. Then in 2027, things start to accelerate as more vehicle programs enter volume production, pushing revenue into the $450 million to $650 million range, and bringing cumulative backlog conversion to around 12 to 14%. And this is when the business begins to look like a real, scaling semiconductor player. But the true inflection point comes in 2028, when multiple ADAS and radar programs hit peak production, potentially driving revenue to $800 million or even over $1 billion, and only then do you see about 25 to 30% of the backlog actually realized, which means the majority of that $7.4 billion is still sitting beyond 2028, likely stretching into the 2028 to 2032 window. And that's the key insight most investors miss. Automotive semiconductor backlogs are long cycle, often spanning 5 to 10 years. So, while the headline number looks huge, it's not a short-term revenue guarantee. And on top of that, not all backlog converts, with a realistic 10 to 25% haircut due to delays, cancellations, or pricing pressure, plus ongoing supply chain risks that can push timelines out even further. So where does that leave us today? With the stock trading around $4 and a market cap under $1 billion, Wall Street currently rates INDI as a moderate to strong buy with price targets as high as $8, implying significant upside. But this is clearly a high-risk, high-reward play tied to execution in a competitive industry dominated by much larger players. So the bottom line is simple. INDI Semiconductor isn't a near-term earnings story, it's a long-term scaling story. And if the company successfully converts its backlog into real shipments over the next several years, it could become a major player in automotive semiconductors. But if execution slips, that massive backlog won't matter nearly as much as it looks on paper. So the real question is, do you believe in the ramp, or is the risk too high?